Good morning and welcome to the Washington County Chamber of Commerce's morning briefing presented by Community Bank. I'm Jeff Catula, president of the Chamber. There's no question that the real estate market, both nationally and locally, have been confronted with new challenges presented by the pandemic. And to discuss those challenges and new opportunities with us today is Jeff Burd, president and owner of Tall Timber Group. Good morning, Jeff.
Good morning, Jeff. How are you?
I'm doing well. How are you this morning?
Better than I thought. Better than I deserved.
Well, thanks for being with us this morning. Jeff, let's start by talking a little bit about you, your background, and of course, what is Tall Timber Group?
Well, I guess the easiest way to describe me is I'm a content provider and have been since before it was hip. I started actually almost 40 years ago this coming weekend, President's Day in 1981, working for McGraw-Hill in a division that published reports on construction. And in 1994, I went out on my own and started a competitor to them. I've sold that business in 2005, but the Tall Timber Group, which is cleverly named after the street I live on, is really just a research and content providing entity. I publish a couple of magazines, BreakingGround and Developing Pittsburgh. I have a blog called BreakingPittsburgh. And I do a lot of private research for the real estate community, the construction community, and even on some levels for local and regional government, even the housing authority or the HUD entity for the U.S. government.
Okay. Now, Jeff, I know we here at the Chamber and Washington County have called upon your expertise numerous times, and we're looking forward to some thoughts of yours this morning on the real estate market nationally, regionally, and of course in Washington County. So let's start talking about the national real estate market and situation. What are your thoughts on that? Where are we now? Where do you think we're moving forward to?
Well, I think the 6 months ago, the real answer was we don't know. Obviously, with vaccinations rolling out, we've got a bit of a sense of, I don't know how else to describe it, but where the end of the runway is. I don't think we know for sure the distance between us and the trees, but we can see them at this point. Obviously, the real estate industry, whether commercial or residential, has been affected by COVID-19 and all the mitigation. It's really more the mitigation of the spread that's been the impact. I think one bit of wisdom that's evolved is that this is mostly accelerated trends that were already in place. The office market has kind of been a little topsy-turvy. It's not been disrupted nearly as much, but when you think about co-working, open floor plan office, and work from home has been a trend that's kind of been up and down over the last 20 years as technology has enabled it. Certainly in certain professions, lawyers, accountants, people were already doing that, maybe extending long weekends by working at home in areas like San Francisco or New York, where commutes consumed a lot of time. Obviously, for the retail sector, you're kind of talking about the same sort of thing. There was a big growing trend towards e-commerce that was putting stress on the brick and mortar location. That's been accelerated. The opposite side of that coin is this pandemic has also accelerated the growth of industrial, warehousing, last mile distribution, things like that. The other upbeat part of the real estate market has been residential real estate. Something that candidly I would have said that's bunk a year ago. That's a trend that is real. Is that by staying home, people decided I need to invest in my house. Mm-hmm. There was a tremendous surge in private residential investment in people in the individual home. People built decks, they put additions on, they remodeled their house. There's also been a very an extended period of pent-up demand for new housing. We dipped so precipitously after the mortgage crisis, underbuilt for so many years, that between that, there was a real crisis that still exists in lot inventory nationally. That's a theme you'll hear in Western Pennsylvania. And I think sort of the delayed start of what was a normal progression for the younger generation. The unfortunate, my kids who are in their 30s, that generation that we call the millennials, uh, has delayed home ownership to a much greater extent than the previous couple of generations. So there's been this pent up demand that really got unleashed last year when people realized, I'm here for the duration, and I don't know what the duration is. I would have thought caution would have kept people from spending so much, but housing was up, and that's a theme that's both regional and national.
I know we're going to talk a little bit about housing, especially in Washington County, in a few moments, but I want to kind of switch your focus now from more of a national perspective to a regional perspective, the Greater Pittsburgh region. How do you see our commercial and residential real estate prospects?
Well, it's a great way to introduce it, because the regional residential really is almost a mirror, almost a reflection of the national that we just talked about. Commercial, I think there's a little bit of good news in that, Pittsburgh's stodginess, if you will, as a more conservative market. We don't have the transactional developers here to the degree that there are in other regions because of our deal velocity, which is much slower. Our growth is much slower or relatively flat. So we tend not to get out over our skis, which means that there was an excess inventory. We weren't looking at an imbalance. And so, again, these trends that were accelerated during the past 12 months have kind of worked in our favor. We were lucky to have some decent inventory of lots or pad-ready lots for industrial. And that has certainly played out in terms of the increase, significant increase in absorption of industrial space, but also construction. And we really didn't have a robust market in that hospitality market. A surge for Western Pennsylvania is 5 hotels being started in the same year, whereas in New York City, that's a month. So we had seen that little bit of a surge in the mid-teens, 20 teens. So really, we only had one. I mean, it might literally have been one hotel on the sort of in the pipeline last year, and it stopped. So we haven't seen so much of an erosion in that part of the market that has taken the hit. We had already seen an erosion in retail, with the exception of a couple of malls and a couple of communities where there's just kind of always been strong retail support. So, much like in 2010, we didn't really have the severity of the downturn to recover from. And that plays out across sort of all of our economic areas, but commercial real estate in particular. We're fortunate to have lenders here and finance conduits that are pretty conservative, not conservative as in unwilling to keep up with the times, but just again, because our developers tend to be the kind of people that build something and then hold it and collect rent. The question of how this gets paid back is real. They're not flipping it in 3 years and making it the problem of a REIT or some big private equity fund. The person that builds it is often the one that's still collecting rent in 5 years. So the question of how are you going to pay me back is one that impacts the person developing it, and we just tend not to get not to abuse that analogy, but to get too far out over the tips of our skis here. So we're positioned in pretty good shape. I think the real question will be, as we grow out of this, or as we come out of this, how much growth will there be? It's obviously quite relevant for your audience to note that for all the back patting we did for ourselves for the last 10 years about what a great region and isn't Pittsburgh so great, without finding that resource in the Marcellus Shale and Utica Shale formations 10 years or 15 years ago, we may not have come out of the last recession so happy. If you pull out that fabulous growth that occurred, almost entirely in your backyard during the early part of the 20 teens, the growth that we experienced here in the region might not have been quite so sanguine. And I don't see that necessarily on the horizon. I think we have some extremely strong growth engines coming, particularly in emerging technologies, but those will not burst upon the scene quite as quickly as as we saw with the natural gas industry 10 years ago.
Jeff, that's a good segue to a discussion on Washington County. But before we go there, I do want to remind our audience that we do welcome your questions, and please submit them with the Q&A function at the bottom of your screen. And I know Jeff's very happy to answer some questions for you from our audience. Jeff, turning our attention now to Washington County. Washington County typically has had a pretty steady growth rate, especially in industrial and flex. How do you see that in terms of the national economy, regional situation, and of course for our county as a whole?
Well, I think there are two major themes to look at in terms of Washington County. And one is a positive, one is at least temporarily not a positive. And we'll start sort of with that one, which is the slowdown in the development of the gas industry, which I think was not unexpected. Certainly, anybody that follows that industry, whether it's the oil industry or the gas industry or any of those energy, heavy commodities, the reality is those industries are up and down. Part of that 15 years I spent with McGraw-Hill, 6 of them were spent in Texas. Actually, during one of the worst real estate crises back in the mid 80s that the country's ever experienced. That's just part and parcel of that economy. And we're going to have a bit of that here. It's a bit extended over normal just because that boom that came from shale production has kind of been both a two-sided coin, and the amount of gas that was there, the commodity itself, just was so much more than the demand that the price is probably going to stay depressed for a while. It's exaggerated or accelerated, I guess, the natural consolidation that tends to take place when one of these exploration booms occurs. But I think we're already starting to see with some of the major regional players, certainly with CNX, sort of the new economics and an understanding of how they have to move forward, which means as the price begins to rise with demand and with other considerations that are being done in the industry, there's going to be room for capital expenditures. You're going to start seeing some growth again, although not probably immediately. The really interesting good news story about Washington County, and this isn't new, but it definitely has accelerated the last couple of years, is the amount of new housing being started. Cecil Township was the municipality with the most housing starts last year in the region, in the 7-county region. 4 of the top 7 municipalities were in northern Washington County: Chartier, Cecil, Peters, and North Strabane. That alone doesn't drive an economy, but certainly it supports that neighborhood infrastructure, retail, the local tax office, the dentist, the doctor, et cetera. But it's also kind of an indication, northern Washington County certainly didn't need validation as a suburb, but it certainly validates that whether it's a regional, meaning a local commute, or whether you're commuting to downtown, that northern Washington County has the infrastructure. It definitely means it's got the school districts. These people don't live where there aren't strong school districts. And it means that there's a healthy economy. One of the reasons I dwell so much on housing and housing construction is that it's a reflection of the economic well-being of the consumer that's in that area. So the fact that you've got a lot of new construction, and new construction just isn't inexpensive. The average new home on the construction side is probably $350,000 to $450,000. There's a significant amount of this new inventory that's being built in northern Washington County that the price is $500,000 to $750,000. And that's not one-off. A lot of millionaires building on big ground. That's neighborhoods, which every house is that way. So it sets things up for a great base of support for the school districts, and a great base of support for that commercial infrastructure. I think where the real opportunity lies for Washington County is on that industrial real estate side, and it's really on both sides of the county. On the eastern side, the Mon Valley side, you really see some momentum building there. I think the Mon Valley Authority has done a good job marketing and bringing up to speed, Alta Vista, the older parks in Charleroi and Denora that are starting to see some user growth. And on the western side, I think because they're beginning to run out of land that's developed in Western Allegheny County, and Western Allegheny County is obviously cheek to jowl to Northern Washington. It's spilling over. In fact, probably the next big industrial development is going to be with Imperial Land Company, the Alo brothers, it's kind of being referred to as Fort Cherry or the Midway McDonald area, but out there along 576, about 900 acres in the first 3 phases. It'll be a very interesting test of just how much the Southern Beltway opening up to the airport, obviously then having access to that sort of petrochemical corridor, will spur industrial development. But I suspect it will, if not open the floodgates, it will really be that next step. And it kind of opens up another area of Washington County that strategically makes sense in terms of the natural assets in the western part of the county, the infrastructure that's been built, and where there's available land. So it's exciting to think about. It will be a test. I mean, it's obviously it's possible that it won't take off, but when you look at the kinds of things that drive economic development, it's those ingredients are there.
I really think on how you look at it, the Southern Beltway really starts or ends at near South Point, depending of course on how you look at it. So let's talk about South Point for a minute. As you know, South Point has a lot of office space, and there's been some thoughts concerning the pandemic, people working from home. Are people going to come back to work? Is this stay-at-home situation going to be continuing even when the pandemic is slowed down? What are your thoughts on that, Jeff? Do you think people will eventually go back to a traditional office space environment, or perhaps will this stay-at-home, work-at-home continue?
Well, we'll start with one caveat, and that I don't blame the viewer if he says, well, what the hell should I listen to the rest of it for? But the real answer is I don't know, and nobody does. But we're starting to be able to form some opinions based on some observations. So maybe we'll start micro and work macro instead. I had the opportunity to speak to a couple of the landlords, the developers at South Point, and was surprised to hear that they were in fact seeing a lot of traffic from employers who had locations either in the city, in the CBD, in Pittsburgh, or in that sort of near urban core, that were looking for, granted, small spaces, maybe 2,500 square feet or something like that, but where they could offer this, what's being referred to as hub and spoke. A law firm, an accounting firm, engineering firm who has South Hills based or West based employees that just don't want to come into a crowded urban setting, would have a satellite office that they could go to where they can be connected as an office, where they can perhaps collaborate. That was a suggestion throughout this pandemic that candidly I wasn't all that keen on how realistic it was. But obviously the people that have that would be living there are seeing an uptick. Now, whether that's translated to leases or not, I don't know. Clearly what's beginning to emerge that we could start to see after Labor Day is a certain amount of fatigue with work from home. There are pressures placed on the employee, if they're young children, for example. The mantra early on that I sort of had to throw the red caution flag on, which was my people are just as productive. Well, the economy shrank by 30%. How productive did you have to be at that point? I think the feedback lately is more along the lines of, yeah, they're keeping up, but, and I think there's starting to be some fatigue. There was a couple of very interesting articles in the last few weeks as depending on where you are, you've gone through now the sort of third round of, hey, everybody stay home, and we really mean it. That just the fatigue is really setting in. I think more to the point, and this is something I've seen in the, one of the main industries I cover, construction. The contractors were basically back to work within a couple of weeks of the lockdown starting. They were considered, belatedly here in Pennsylvania, but considered an essential industry. They developed very, very rigid safety guidelines, and were very, very good at when those guidelines were breached. And they were breached almost entirely outside of the workplace. Workers going out for, going traveling or going and having a couple of beers on the weekend and somebody getting exposed and coming to the site. They really knocked it down quickly, isolated those people. So we really haven't had outbreaks. As far as I'm told, not really any place in the country, but certainly not in our part of the country. And with projects like the Shell Cracker, where you had a lot of workers in a very small space, relatively speaking, there was an imperative that happened that way. More to the point, those same companies have found it really necessary to be in the office, at least on a limited basis. And what they've discovered is wearing masks, maintaining, staying in their offices, when they have to collaborating from a safe distance, sitting in a room that's well ventilated, or for part of this time, obviously sitting outside, even holding meetings outside, has led to situations where there haven't been outbreaks in the office. Doesn't mean employees haven't tested positive or they haven't had situations where maybe just out of caution, they've said, hey, this week, we're going to stay home. But I think, there's sort of like the schools. They're starting to find out that by being just sort of basically cautious, you can keep the office place from being a place where there's community spread, which is for the time being the real critical thing while we roll out the vaccines. I think as an employer, I'm at the end of my employment career, if you will. The next 10 years is going to include my retirement, not the expansion of my business. But if this was 25 years ago, I'd be very concerned about my ability to create a culture, to identify and mentor who are the next generation of leaders in this company, and certainly to problem solve, where you really do need to be sort of together. I think these kinds of things, medium, whether it's Zoom or any of the team building things, are sort of underrated. It's popular to sort of joke about your Zoom conferences, but the ability for me to look at you in the eye, Jeff, I can get a reaction. I know, I just have that sense that I'm engaging someone. Now, if there were 32 faces on the screen, that's a little different. But for 4 key people on a project, for example, or 3 key players on a leasing situation, to be able to look at each other in this medium still works pretty well.
Those are interesting points, especially about talking about engagement in terms of being in the office. And that kind of leads to our first question from one of our audience, if you don't mind us taking a couple, Jeff.
Sure.
The first one concerns like the downtown business environment. I'm sure our participant here wants to know about the Pittsburgh downtown, but what do you think about downtowns in general? The downtown Pittsburgh market, which was doing well. What do you see those long term to be?
Well, that's an interesting question. That's definitely a to be determined. I think everything that we have seen over the last 90 to 120 days suggests that yes, there is a certain trend that people don't want to be in downtowns. There's some things that I tend to take for granted or dismiss because I'm in a suburban office myself. That is, I don't have to get on an elevator. I'm not standing in a crowded diner or restaurant every day, so that a certain amount of that I think adds to a bit of the unease. Now, that said, humans are wonderful amnesiacs. We'll forget, I think, very quickly when we get a couple years down the road, and that trend ignores what makes CBDs CBDs. The density of food establishments, bars, theaters, lifestyle amenities in most cities living. Most cities have a much higher share of residential in their downtown. As it relates to Pittsburgh, I'm gonna disagree with one of the things a comment you made there, that Pittsburgh's downtown was doing well. In reality, this pandemic is somewhat disguising the fact that from an office standpoint, the downtown market had already begun to experience some real softness. That was sort of started probably 17 and 18, but definitely coming into 2020, that was a prevailing trend. There was movement away from downtown to the fringes. And I mean, this is just something you can't really avoid. The reality is that downtown Pittsburgh had become, as it evolved away from being a corporate headquarters in the 40s, 50s, and 60s, it had become more of a service hub. Lots of law firms, lots of accounting firms, maybe some creative agencies and things like that. But for the most part, other than the few major corporations, PPG, US Steel, BNY Mellon, PNC, that were downtown, there was a heavy share of that downtown user group was, frankly, groups that were already looking to become smaller. Law firms with technology were able to eliminate a lot of space even as they grew in headcount. All these sort of things have sort of exaggerated what was already going on. I think that's a real concern for downtown, in that the professions that seem most likely to not return to the office are the ones that were bigger users downtown. I have there's some friends in law firms that are my peers, so in their early 60s, who surprised me to say that they basically think they won't return to the office the rest of their careers. They tend to be fairly singular discipline kind of professions. A lawyer does need to collaborate from time to time, but a lawyer can work on a case or do 40, 60, 80 hours of billable time alone in their office or one-to-one with a client, and they don't need to be in that office. Because the downsides of the CBDs are you have traffic getting in and out, you've got parking concerns and others that, if you can avoid them, it's better to do so. So I think, I do think that central business districts over the long haul will rebound. I mean, I think nationally by 2023 or 2024, you'll see that trend already, well underway. But the downtown office, I think more than any other, is going to have to be sort of adaptive. The other thing about downtown Pittsburgh that sort of gets a little bit overlooked, much like the gas industry, gets overlooked in terms of its role bringing Pittsburgh out of the recession 10 years ago, is that if you pull Point Park out of the equation, taking a significant number of buildings out of the inventory for office, and if you pull UPMC out of the equation, which took 1.2 million square feet or 1 million square feet in the US Steel Tower, essentially they took the entirety of one Oxford Center and leased it at one time. If you took those two factors out of the equation, the downtown office market was already experiencing some stress, or would have been experiencing some stress. So another rejuvenation of downtown is probably in order. I think the fact that there is so much more lifestyle amenity and downtown living that wasn't there 15 years ago is a real plus. And there's a really just an outstanding group in the Pittsburgh Downtown Partnership that works sort of proactively, tries to get ahead of where these trends are. That I think that market will recover, but I believe it'll look different from what it currently looks like.
Well, Jeff, we certainly appreciate you being with us this morning. You've always been a great friend of the Chamber in Washington County. We appreciate your insights. We do apologize. We had numerous questions this morning. We couldn't get to them all, but Jeff, I know you're always welcome if we steer some of these questions your way.
Please do. Please do.
Jeff, thank you. Jeff Burd, owner and president of Tall Timber Group. Thank you very much for being with us this morning.
My pleasure. Thanks, Jeff.
I'd also, again, like to thank Community Bank for their continuing sponsorship of this event. And as we move forward into March, we're going to be hosting our Washington County State of the Economy presented by Community Bank. As you know, that's our annual update on things happening in Washington County in terms of our economy and where we see our future. This year, we're going to do it a little different. We're going to do it virtually over the course of 3 weeks. So we're going to have some great speakers starting on March 11th with the Washington County Commissioners giving their annual economic update. Something you won't want to miss and something we hope you tune in for. On behalf of the Washington County Chamber of Commerce, Community Bank, and all of our members, thank you for being with us this morning. Have a great day.